articles on the relationship between asset prices and monetary policy, which have been published in top academic journals. With a PhD in economics from Princeton University and prior expertise as an economist at the Federal Reserve Board, Refet brings a wealth of knowledge and expertise to the stage. As an aside note, Refet also helped us organize a very successful conference on inflation dynamics, expectations, and targeting a couple of years ago, and we hope that we will be able to collaborate and reinvite you in person again soon. Today, Refet will present his latest paper titled News and Noise Shaping International Yield Curves. I'm confident that it will be an intriguing talk, and Jonathan will manage the session. Just before we begin, Refet is from Turkey, and we wish to express our sincere condolences to the people of Turkey, especially those who have been affected by the recent devastating earthquake. Our thoughts are and prayers are with all those who have been affected by this tragedy. So with this, I think we can start. Thank you, Refet, and the floor is yours.
This is very kind of you, Itamar, and all of you. Thank you for the kind words and the, I guess, sincere thoughts, and also for the invitation. We, of course, didn't know when we arranged this day and time that it was going to be such a terrible time. But I'll be talking about what I know, which is macroeconomics. So let me share my slides and get to this. Okay. This is joint work with Mark Kersenfischer of the Bundesbank. Mark is young and wonderful. Burçin Kısacıkoğlu, a faculty member at Bilkent, and Jonathan Wright, faculty member at Johns Hopkins. And since Mark is there, I have to say this doesn't reflect the opinions of the Bundesbank. Although I don't see any reason why it should not. Now, this is going to be work that that relates a lot of things to each other, and it's going to be kind of messy. It's also ongoing. So I'm going to give you a very nice, neat story, and then tell you why the paper isn't done yet. So there is this quirk that we haven't quite understood yet, and Mark, you know, kudos to him. He noticed that there is this issue, and for a while we thought this was a minor wrinkle, and now we think that there's actually something to be understood there. So we're still working. Okay. So it begins by something that anybody who looked at a yield curve thinks about, which is, you know, why is this thing all over the place? Okay, and the standard answer there is that it's the level factor that's moving the yield curve. Okay, that answer is correct to the extent that it's an answer, but it's essentially tautologically correct. To remind those of you who haven't thought of these things in a while, a yield curve is the relationship between maturities of bonds, right? This is for the sovereign, and their interest rates, okay, the yields. So it really is, you know, this bond at this maturity at this yield, 1 point, next point, next point, next point. You connect the dots, okay? It's a bit more involved than that because you have to think about coupons, coupon frequencies, coupon rates, but that's more or less the idea, okay? And you can do this at any frequency you want. You can plot these yield curves, you know, every month or every day or every minute if they are trading, right? And if you look at those curves, they're all over the place, okay? Now, someone smart said, it really can't be that if I take this yield curve and look at the many points on it, okay, there are as many independent movers of this yield curve. That is, think of the yield curve and imagine that you're looking at this not in frequency now, not over time, but in the maturity dimension, okay? And you're asking, you know, what is happening to the 1 year yield? What is happening to the 2 year yield? What's happening to the 3 year yield, okay? So you're chopping this into 1 year bits. You'll immediately see that there is no way, I don't know, the 7 year yield is moving in a way that is independent of the 6 year yield and the 8 year yield, okay? There has to be a lot of correlation there. So you're not looking at as many independent points, okay? That naturally calls into question, what are the, you know, how many latent factors are there that move this yield curve, and what do they look like, okay? So the standard way of doing this is to do a principal components analysis on the yields. And it turns out one factor explains, this is true for the US and most other countries, one factor explains about 85 to 90% of the variance of the yield curve. Okay, and that factor is called level because that's the factor that loads evenly on all maturities. That is the thing that makes the yield curve move this way. Okay, the second one that explains maybe 10% or so is called slope because that's this rotation. And then there may or may not be a third one. Of course, we can estimate it, but statistically, it's sometimes there, sometimes not. That does this. Okay, that's the butterfly or the curvature factor, and it's very small, 2-3% of the variance. Now, hence, what moves yield curves? Level, of course. Level yield curves usually move in a level fashion, but that really deflects the question. Okay, because then you have to ask, well, what moves level? What is level? Why is it level? And in particular, what is it that is leading to this level shifts? Okay, so this paper is going to be mostly on that question. Related to this is something that breaks our hearts a lot. Imagine the time of, this was last Friday. Imagine the US employment reports release. Okay, imagine that you were looking at the US, I don't know, 2-year yield, 5-year yield, 10-year yield, whatever you're interested in. Okay, and you're asking, how is this thing going to move on a tight intraday window? Something like, you look at the yields 5 minutes before the release of non-farm payrolls to 15 minutes after the release. So only in that very narrow 20-minute window, you're trying to understand the movement of this one yield. Okay, so what you could, of course, do is to take the change in that yield, do this for every employment reports release day, and only on that days, only in those narrow windows, okay, run the change in the yield on the surprise in the non-farm payrolls. Because there are very good surveys on this. People are asked, and these are not, little old ladies, these are professionals who are actually trading in these markets. They are asked, you see this on Bloomberg, right? What do you think the non-farm payrolls number is going to be? So you have the median expectation, you have the realization, the surprise, okay? So run the change on the surprise. You'll be happy to know that it comes in significant. You'll be, if you didn't know this, devastated to know that when you run this kind of regressions, your R squared oscillates between 20% to maybe 35-40%, okay? And that's really terrible because, stock prices were kind of a bit happier not to understand because, so many different stocks, so many firm-specific things, maybe bubbles, whatever. Bonds, these are all the same sovereign, right? We think that we have an exact handle on bond yields. They have finite lifetimes, maturities. We should be nailing these things. And even then, and I'm not asking an unconditional understanding, right? All I want to do is when the news that I know is moving the yields hits, let me see that I can map the news to the bond price change, okay, to the yield change. And what turns out is on a good day, you explain a third of it, okay? And this is not the good day, right? It's on a good 20 minutes, you explain 1/3 of it, and 2/3 you still don't know, right? So this line of analysis is going to say, we actually do understand. The problem wasn't that news don't move the yield, it's that our methodology didn't allow us to see this, okay? So there's going to be, hopefully, a methodological contribution. So we're going to say, we have to know where to look, how to look, right? And to give you a sense of what is to come, if you think about this non-farm payrolls release, for example, there is no non-farm payrolls release. It's the employment reports release. In it is non-farm payrolls, unemployment, average earnings, revision to last month, how much of the employment change was government versus private sector, how much of the employment change was temporary versus permanent. It's actually almost 40 pages of data, okay? Now, some dimensions of this we survey so we can map. Some other dimensions, we don't. There are no surveys, so I don't see the surprise by the econometrician. But from the trader's perspective, from the market participants' perspective, they have beliefs about all bits of this, and they learn something from all bits of that, and they react. So what happens is, although they are reacting to news, since it's unobservable to me, I can't condition on it. It has to show up in the residual. If you have that understanding, then you can work this into your measurement, okay? And this is going to be the econometric contribution, so to speak, the contribution to machinery, that actually allows us to think about what is called heteroscedasticity-based identification and to merge OLS-based event studies with heteroscedasticity-based event studies. Okay. I told you these things. Yeah. So this Gürkaynak surgical right. This is the paper without mark that Jonathan Burchin and I wrote, and it came out about a year ago, December 2020, in the AER. Okay. So we're going to start from there, and I'm going to spend quite a lot of my time talking about the machinery in there. And then in this paper, we're going to say, how do we use that idea to look at international transmission of shocks? Okay. The Euro area versus the US. Right. Okay. Blah, blah, blah. All right. So what we're going to find at the end is that we will be able to relate both the US yield curve and the Euro area yield curve to news. And that's good. Okay. In particular, we will do a great job in explaining the short term, you know, that 2-year, maybe up to 5-year yield curve. Okay. And then it's going to turn out, and these are the parts that are a bit shaky now. Okay, it's going to turn out that we also get to explain the long end of the yield curve in the US with news, sometimes with observed news, sometimes with latent news. Okay, but not in the Euro area. And one thing that we are able to do by this machinery is we will be able to splice the yield curve movement into the part that is due to observed news, the part that is due to latent news, the part that is due to ever-present noise, which is not going to be a residual. So we're going to have a good way of handling noise, okay? And then proper error. That's going to separate us from almost all of the literature where people have some vague sense of fundamentals, and they're going to have a fit that are going to call the fit to the fundamentals, and the residual is going to be noise. Okay. For us, noise is going to be a well-defined process too, and I will have a handle of it. So I will have news, noise, and then error. And what I'm going to find is this error is going to be actually irrelevant. It's really all news and noise. Okay. But the news noise contributions, relative contributions, are different in that on the short end of the yield curve, both in the US and the Euro area, it's all news. In the long end of the yield curve in the US, it's also all news. In the long end of the Euro area, it seems it's more noise. Okay, I will tell you at the very end that there are some issues in the way our estimate of noise look like. That's what we're working on now. And conditional on that, there is going to be some understanding about why is it that the long ends of the US and the Euro area are behaving differently. And that's going to be the anchoring story. That it seems, and this too requires a bit more work, but currently it kind of seems that the long end of the Euro area yield curve is better anchored. Okay, and therefore it's not that there is more variance in the Euro area yield curve, hence there is more noise. It really is that it's about the same amount of noise in the both, but current news move the long end of the US yield curve a lot, which is consistent with unanchoring, which makes a lot of sense because until 2012, the US did not have an inflation target. And I have a lot of previous work that says that lack of inflation target leads to learning about the steady state all the time, which leads to long end moving around, whereas the Euro area always had an inflation target that was reasonably credible. And therefore, news transmission to the long end is less in the Euro area, which leads to, in an R-squared sense, news contributing less, and therefore noise contributing more to the long end variance of the Euro area yield curve. Okay. By the way, I've been talking nonstop for 15 minutes. I'm very happy to be stopped, disagreed with, asked questions. Okay. Yeah. Very good. Yeah. All right. So let's look at this. I think for this audience, these are not terribly interesting. We're looking at asset prices. We have to condition on the surprises, all that. Okay. So the machinery that is interesting is this. Every time I present this, I remember that I keep changing the notation. Every time after the presentation, I leave it as it is. Every time I re-go and do the presentation, I forget to fix it. So the notation is going to move around. I apologize for it. But if you haven't thought about event studies before, this is the way to do it, okay? YT is the change, it's not the level, it's the change in the asset price I'm interested in. For me, this is going to be a change in a yield, okay? S star is the surprise in the data that I learned in my event window, okay? Release of non-farm payrolls, release of retail sales, release of CPI, whatever you want it to be, okay? Alpha is my parameter of interest. Want to understand how this data release affects the yield here, okay? And epsilon is the error in this process, okay? Now, the problem I have is perhaps the surprise that I measure, ST, this is the surprise that is observable to the econometrician, that might be measured with error, okay? So it's the true surprise plus an IID measurement error. This really is classical measurement error. And usually the thinking is the release is observed perfectly, which it probably is, but the survey might have all kinds of problems, okay? You know, people might tell you, 5 just to get you out of their hair. They may have an incentive to get the extreme event right. They might tell you 5 because they believe in that, but they told you this 4 days before the release. And then as the date comes closer and as data keeps coming in, they change their beliefs, but you have no way of knowing this. All of these lead to measurement error. And if you recall from your undergraduate econometrics, a system of this sort, where you only have the data on the yield change and the observed surprise, this cannot be identified. You cannot estimate this properly because you have 2 series, which gives you because of symmetry, 3-entry variance covariance matrix. So you have 3 bits of data to work on things. And you have to identify what alpha is, the variance of S star, the variance of epsilon, and the variance of eta as 4, no go, okay? Thus, the question is, how do we do these event studies, okay? Well, if you're like me, you assume the problem away and say, yeah, measurement error, nah, I don't think that's happening. Essentially, you assume that the variance of eta is 0, okay? In which case, you're done. Now, S star and ST are the same thing, and you can just run OLS here, and that's perfectly fine. In fact, these event studies are great ways of teaching OLS because it's one place where we know the OLS assumptions have to be satisfied. On the right-hand side, you have surprises. So these have to be IID, okay? So you could run your OLS. On the other hand, if somebody says, how are you so sure that your survey is so good? How are you so sure that you're actually identifying alpha correctly? Well, you can't be sure, right? But you could ask, assume that I can't be all that sure. What else can I do, right? For the longest time, the answer was nothing. And then came Roberto Hugo, who said, you know what? Actually, the way we are running these event studies throws away a ton of data. Why? Because you're only looking at the event windows. To which I would say, of course, because that's where the action is. Why would I want to introduce pure noise by putting in the non-event windows? And this is me being very dumb, because Roberto would say that's exactly why. Because the non-event window has pure noise, and you're trying to learn about noise too. Noise is the variance of epsilon in this setting, okay? So the thinking is this. Imagine that measurement error cannot be ruled out. Can I still get that transmission parameter, okay? And that is the heteroscedastic base identification. If you haven't studied this before, it really is beautiful, okay? The thinking is this. Let's show this. I have actually 2 windows, okay? 2 sets of data. The window in which the event actually happens, the event window, and it has a variance covariance matrix, okay? That variance covariance matrix says the variance of the yield change in the event window, okay, is the variance of the noise plus variance of the true surprise plus or times alpha squared. That's really basic statistics, okay? The variance of the true surprise, the variance of the observed surprise, because of orthogonality, is the sum of the variances of the true surprise and the measurement error. And the covariance is this, okay? Fine. Now, heteroscedastic identification says, look, what happens in the non-event window? In the non-event window, the transmission parameter alpha is the same. Whatever is happening there, okay, on the surprise side is still affecting the yields the same way. The variance of the noise is the same. The variance of measurement error, to the extent there is one, is the same. What changes? What changes is the variance of the surprise, right? Clearly, even if you're learning something about non-farm payrolls on non-event days too, on the event day, you learn a lot about this. It can't be drawn from the same distribution, okay? So the variance of the true surprise is different. What happens? Between the event window and the non-event window, you end up with one more parameter, variance of the true surprise in the non-event window. But you also get 3 new variance covariance matrix entries in this variance covariance matrix for the non-event window, okay? The way we are implementing this, in the non-event window, there are no surprises. You learn nothing. Thus, the variance of the true surprise is 0, okay? Variance of the true surprise is 0. The covariance is also 0. Thus, the variance of the yield is only due to the noise, which tells you, you actually know what the noise is. But if I know what the noise is, then I could just substitute in here, okay, and back out alpha squared. How? Basic matrix algebra, okay? Subtract these two matrices from each other. This sigma squared alpha drops out. Look at this is now the difference matrix. Look at the entries. Alpha squared, sigma squared star, alpha sigma squared star, okay? Divide the 1, 1 entry with the 1, 2 entry, and you're gonna get a measure of alpha. That is the heteroscedasticity-based identification of alpha. This is beautiful, right? So Roberto said, look, you actually don't have to assume no measurement error, okay? As long as you're willing to say, yeah, I understand that I'm giving up homoscedasticity. I understand that there is heteroscedasticity of unknown sorts between the two windows. You can actually identify. In fact, if you work through this, you can see there are more ways in this this matrix of identifying alpha. So you can over-identify alpha and run a test of over-identification too, okay? Now, this was Roberto's PhD dissertation, and it was extremely successful, as it should have been. And Roberto and Brian Sack wrote a series of papers, utilizing this, operationalizing this for these kinds of efforts. Okay. What happens? What happens is you do the same event study with OLS, and then you do the same event study with heteroscedastic identification, and your parameter estimates go up by an order of magnitude or many orders of magnitude. Roberto and Brian look at this and say, ha, we knew this. This is exactly what should happen under attenuation bias. If you had measurement error in OLS, OLS will be biased towards 0. When I correct it, the true parameter turns out to be much larger, which is correct. We are going to say, it may be, but there is another reason why you might be finding this, okay? Let's first see this. This is a difficult table to read, but let's take a look at this. This is for the euro area yields, okay? So pick any one that you are interested in, right? The euro area 2-year yield change as a response to US unemployment, for example, okay? This is the unemployment surprise. So I don't want unemployment for a reason. Let's look at, I don't know, something I can relate to better. How about core CPI, this one? US core CPI, 0.3. Okay, so keep this in mind. Let's do this with heteroscedastic rate identification. Right? 2-year US euro area yields, core CPI. This used to be 0.3. It's now 3.7. Okay, so it has been up 12-fold. Take my word for it. Every single parameter in this table is way higher than the corresponding parameter here, which is exactly what would happen under classical measurement error, attenuation bias, okay? You would also have noted that this table is in much larger fonts than the OLS table, and you might be wondering, how are these the same regression? How are these the same analysis? And you'd be absolutely right that they cannot be. Let's note here that here I have a line for non-farm payrolls, right? That says the US non-farm payrolls release, moves the 3-month euro area yield by this much, the 1-year euro area yield by that much, whatnot, okay? Here I have non-farm payrolls too, much lower parameters. Here I also have unemployment below, right? And I go to the heteroscedastic-based event study table and I look for unemployment, and I cannot find it because it's not there. Why not? If you thought about it, let me give you the answer. OLS conditions on the size of the surprises. And in the same release, there are different sized non-farm payroll surprise, unemployment surprise, hourly earnings surprise. Those are all parts of the same release. Okay? So OLS is able to splice the reaction to these things because they are not perfectly correlated. But heteroscedastic-based identification essentially conditions on the time of the release. In this window, this was released. In that window, it was not released. You cannot do this separately for non-farm payrolls and unemployment because non-farm payrolls and unemployment are part of the same release. They are always released at the same time. Now, you should immediately see the problem. In what sense this coefficient is the non-farm payrolls reaction? Why isn't it unemployment? Why isn't it hourly earnings? Why isn't it government payrolls? And there's no answer to that. Essentially, one sees that heteroscedastic-based identification finds the reaction to the release, the entire report, whatever it is. OLS finds the reaction to the headline news because it conditions on the surprise in the headline. That's what is being surveyed. That is why here you can have CPI and core CPI, PPI and core PPI separately, but here you cannot. Following Rigoban and Sack, we call these core CPI and core PPI, but I could have also called them CPI and PPI, same release, okay? So that gives me the idea that, look, data releases are many dimensional things. I survey only few dimensions of this, usually only one dimension, okay? Think of GDP. The only thing that is surveyed is, what do you think GDP growth will be, okay? But when GDP is announced, together with the overall GDP growth, you learn revisions to past GDPs. You learn whether the GDP growth was coming from exports versus consumption versus investment versus stock changes, right? And all of those give you a different idea about the state of the demand, state of the macroeconomy. So you're gonna react differently to those. There are many different sub-items of information that I am missing when I'm only looking at the headline. OLS, if there is no measurement error, is going to correctly capture the reaction to the headline, and heteroscedastic-based identification is going to measure the reaction to the whole report. Then, under that interpretation, okay, what happens is we're now thinking about a world where perhaps the problem isn't in OLS. Perhaps the problem isn't in measurement error. Perhaps the problem is in heteroscedastic identification that estimates the reaction to the entire release. And the entire release has a lot more information than just the headline, okay? Mechanically, what happens in that case is, this is now truly deeply and heartbreakingly mechanical. In this literature, we always report reactions in per-standard deviation terms. My problem is this. I'm trying to understand the 2-year yield reaction to the GDP surprise and the non-farm payroll surprise, okay? The GDP surprise is a number like 0.1, 0.2 on a good day, right? Because that's the order of magnitude of GDP itself. The non-farm payroll surprise, think of last Friday. The non-farm payroll surprise was about 300,000. Okay, so if you have two right-hand side variables with such different scales, the reaction coefficients are going to be really weird. One of those is going to be 0.0001. The other one is going to be 17.2, but it's not going to capture which one is more important. It's just a scale. So the first thing you do is to rescale all of these things so that you're looking at per standard deviation reactions. When you're doing this with OLS, you normalize with the standard deviation of the headline surprise, which is what you are measuring. When you are doing this with heteroscedastic space identification, you're normalizing with the increase in variance in the event window. But the increase in variance is due to the headline variance and also a zillion kinds of sub-news variances. Notice that as variances, those are all positive. You add those up, the total variance change is way larger. So you're dividing by a much larger number. Mechanically, your coefficient has to go up more. Thus, what this says is, now imagine a world where perhaps you still have measurement error. This is here. But the yield change is due to these observed surprises. These are the surprises I've been surveying, right? So it's non-farm payrolls, unemployment, whatever. But in here, there is also one or more latent factors, okay? FT are the latent factors. DT is an indicator function that says this latent factor only appears in the event window and not in the non-event window. And gamma is the transmission parameter for that. These things are not identified. So the first thing you do is to assume that FTs are mean zero unit variance items, okay? Then the gammas are identified and they really tell you what the variance of FT is. Now what happens? This is a good econometrics exercise, so pay attention, please. Here is what we are thinking. Imagine that the world is possibly a world with measurement error, that's this, okay? Or it's a world with latent factors, that's this. Or it's a world with both, okay? Or it's a world with neither, meaning no gamma here, no eta here, okay? You have these four cases. How would you do OLS? How would you do heteroscedastic space identification, and what would you find? The answer turns out to be OLS is always the same thing. All I see is the series for YT, the yield changes, and the series for SD, the observed surprises. I take those and I run OLS, okay? The machinery of OLS is always take the covariance, divide by the variance, okay, in the event window. The machinery of heteroscedastic space identification is always look at the variance covariance in the event window, look at the variance covariance in the non-event window, do the subtraction, do the division, that's what you get, okay? So now I could ask, imagine that you're doing OLS, you're going through the OLS motions, or you're going through the heteroscedastic space identification motions, but the underlying world is one in which it's one of those four cases. No latent factors, some latent factors. No measurement error, some measurement error. What happens then? Okay? I'm very proud of this. I did this. What happens is this. In the case where gamma is zero, meaning there are no latent factors, and the variance of measurement error is zero, meaning there is no measurement error, then OLS and heteroscedastic space identification are both consistent. They both uncover the same parameter, what I earlier called alpha, and now I'm calling sloppily beta. Okay? I can look at this and immediately say, clearly, I'm not living in this world because I just ran these two exercises and the estimates were very different. Okay? Now imagine, my apologies, now imagine that I'm in the world where there are no latent factors, but there is measurement error. What happens then? Heteroscedastic space identification is still consistent. OLS now suffers from attenuation bias. This is, if you remember your childhood econometrics, right? This really is the definition of attenuation bias. The larger the measurement error is in comparison to the variance of the true surprise, that's a measure of the signal to noise ratio, right? The worse the attenuation is, and in fact, since this is 1 minus some positive numbers, these being variances, okay, and that's a ratio, this is a number between 0 and 1, the OLS estimate is going to be moved towards 0 in absolute value, okay? Now, this is where the literature stopped so far, and people said, yeah, I do OLS, I do heteroscalar space identification. I find a larger coefficient with heteroscalar space identification than with OLS, which is consistent with measurement error. Thus, I conclude that my surveys of expectations for data releases were riddled with measurement error. Okay, fine. Now we are saying, well, hang on a second. Imagine that there is no measurement error, but the data releases have news that are not observable to the econometrician because the market reacts to, how much of the GDP surprise was from inventories versus from government spending, which I don't know because I only see the release of inventories and the release of government spending, but not people's expectations of what those numbers would be. That's not surveyed. Okay, what happens in that case? So now imagine that there is one latent factor. In that case, the latent factor being orthogonal to OLS, you're going to end up with OLS being consistent and the heteroscedastic space identification being biased upwards. And this is your bias, okay? The larger the variance of the latent factor compared to the contribution of the observed surprise to the yield change, the larger the bias in heteroscedastic space identification. So now my problem is, once again, I have heteroscedastic space identification giving me larger coefficients, but this time the problem is with heteroscedastic space identification. OLS is correct. Okay. You could also ask, what happens if you have both problems? Then you're going to have both problems, but they do not interact with each other. Okay. So now I have a question. Now I have a problem. All I see is I cannot be in case one because case one says the two estimates should be the same. They are not. All of other cases say OLS will be smaller than heteroscalar space identification, and I don't know which one is correct. All right. Well, I can do various things. And what I'm going to first do is to look at this. I have to bring in independent information about whether these surveys are any good. Okay. This is of nerdy interest, and the data and the thinking comes from a paper I wrote with Justin Wolfers a zillion years ago. There was a lovely, beautiful market called economic derivatives, very short-lived, unfortunately. Goldman Sachs and Deutsche Bank, right before data release, on the same day, earlier in the day, ran essentially a betting market on what the release was going to be. Okay, so you could buy call options that paid $1, strikes being possible data releases. So, for example, on a day of non-farm payrolls, you would buy a call option at 70,000, and if non-farm payrolls came in 70,000 or above, your option paid $1. You could also buy one at 80,000. If it came in at 80,000 or above, you got $1. I had the prices of these options, the market prices, so I could turn them into a proper PDF and do all kinds of things with that. Why this is nice is for this application, this kind of a market is immune to all of the possible problems of surveys. It's not stale, it's right before the release. No names are associated with it, it's a market price. So people cannot give weird expectations just to be different, just to be talked about, just to get the extreme event right. Okay? People are not going to give you stupid answers because they're betting their money on it. So now I could ask, imagine that I measured the same surprises using the survey versus using the market prices of these economic derivatives. Okay? The difference between the two is going to give me a measure of survey error, survey mismeasurement. Right? So I'm going to run a pseudo regression and ask, are the coefficients I get when I condition on the survey surprises, work at the market-based surprises, are they different? Okay, we're not going to bore you with the details. This is in the AR paper if you're interested, but the answer is they're identical. Okay, you cannot reject the null that the estimates you get from the survey-based surprises are the same as the market-based surprises. Okay, cool. You can also, just by eyeballing, you can see this actually. It's always the case that the survey-based surprise coefficient is a little less than the market-based surprise coefficient, meaning there is some measurement error, probably because of staleness. How much I can quantify? It's on the order of 10% or so. Okay. I also know the measurement error magnitude to explain the difference between heteroscedasticity identification and OLS. That 10% clearly doesn't cut it. It has to be this big to get the order of magnitude difference. The conclusion being, OLS is actually perfectly fine. Surveys are good. OLS gives me the correct result to a particular question. What is the market reaction to the headline surprises? Heteroscedasticity-based identification gives me an answer to a well-defined question. What is the market reaction to the total data release? Now I understand, hopefully for the first time, that these things are not substitutes for each other. They are not different ways of answering the same question. They are ways of answering different questions. Given that, I should think of them as complements. Okay? And that's what we do. So the machinery that we bring in is this. Imagine a world where there are some news that are observable and some news that are latent. How would you back these out? Immediately think of a state space model. Okay? You can show, we did show, that this is actually equivalent to, up to efficiency, running OLS first, getting the residuals, running heteroscedasticity-based identification on the residuals. But you can do this in one step efficiently with a Kalman filter. You can find on our web pages a toolbox that implements this. Okay? So now I'm saying, look, I'm going to run the regression of the yield change on the surprise, and now I no longer differentiate the observed surprise from the true surprise because they are the same. Okay? And a latent factor. Good question. How many latent factors do I need? When I started, my thinking was, we're going to need 2 or 3 latent factors per release. Okay? It turned out 1, and not 1 per release, 1 across releases, which was terrifying and interesting. Okay? So let's look at this. That's here. Not very readable, with apologies, but not very interesting either. The interesting bit is this. Okay? Imagine that you run your regression. Let's look at the 2-year yield, for example, and you ask how much of the 2-year change in the euro area yields in the 20-minute window, bracketing these data releases, do I explain? Okay, when I just run OLS, the answer is 20%. Okay, that's this. And then if I dump in, here I'm going to put in 2. 1 for the US factors, 1 US latent factor, 1 euro area news latent factor. Okay, what happens to the R squared? It goes up to 85%. Okay, and notice that it goes up like crazy over the board. Why is this? Okay, the answer turns out to be this. No, this. This is a very nice way of seeing this. It's not in the paper, and hopefully in the new paper, we're going to put something like this in there. But here's what happens. And I was very surprised to learn this because I've kind of seen this a million times before, but never thought about it. Imagine looking at, let's go back and look at this. These are independent regressions, right? Yes, go ahead, please.
Yes, we have a question from Gökhan.
Yep.
Hello, Refet. When you say the euro area yields, which one do you mean, the Bund or?
These are the OIS changes in general.
Okay, thank you.
Yeah. It kind of depends. So when we're looking at back in time and longer term maturities, then we're looking at the Bund because the 10-year OIS wasn't very liquid it wasn't actually trading at all early in this sample, okay? But the results are fairly insensitive to how we are doing this. But the thing that is worth looking at is this. These are, each point here, each box here is a separate regression, okay? So you take the 3-month euro area yield, you run it on the GDP surprise. Then you take the 1-year euro area yield, you run it on the GDP surprise. Okay, you can do it this way, you can stack them and run them as a vector, all fine, but it's not a VAR. And what you see is, look here, some number going up and then going down, okay? It's kind of this hump-ish shape, okay? Now let's look at PPI, some number, these are not significant, but still the same point estimate. Some number going up and then coming back down, okay? How about, I don't know, non-farm payrolls, some number going up and then gently coming down, okay? Durable goods, same. How about unemployment? This time negative, but same shape flipped, right? Some number coming down and then a bit less. In absolute value, these all have the same shape. And if you look at the US factor, what it looks like, some number going up, coming back down, euro area factor, some number going up, coming back down. Essentially what happens is this, and that was deep learning for me, okay? If you do the heteroscedastic-based estimate of the US non-farm payrolls release for different maturities, this is the shape you get, okay? If you look at the OLS estimate of non-farm payrolls itself, because this is the employment report as a whole, it's the same shape. If you do it for unemployment, which is in the same release and surveyed, it's the same shape. Do it for hourly earnings, same shape. It's always the same shape, scaled up and down. What this tells me is the yield curve always reacts in the same way to different kinds of data releases. So probably the employment report has 50 kinds of surprises in it, but since they all seem to have the same, elicit the same reaction from the yield curve, I can summarize them into one factor. It's the constraint, and the constraint is correct. In fact, the shape that I get from the, let's say, the inflation factor, that's also the same shape. The employment thing, also the same shape. Essentially, I can summarize these things, sum these things up within releases and across releases. Thus, imposing a single latent factor turns out to be a statistically correct restriction, and the data loves it, okay? That's, I have to say, at least to me, this is something very deep and fundamental that we haven't thought about, okay? Now, where this gets interesting is this. I could leave it here, and hopefully you'll be kind of impressed by, wow, you know, machinery is interesting, thinking is interesting, all that. And then in the evening, as you are preparing for bed, you're going to be thinking, wait, the guy just told me that one factor explains the yield curve, and I knew that. It's called level. There's always one factor explaining the yield curve. How is it different from explaining the yield curve with level? And that's a concern. So to go in some ways in addressing that, we're going to change the notation again with apologies. This is the observed surprise here. This is the latent factor, okay? We're going to put in one more latent factor. And these two latent factors are going to be differentiated by the way they are treated. One of these, the latent factor for the releases, is going to be associated with an indicator variable that says, this is the factor that is only present in the event window, but not in the non-event window. And then here I'm going to have one more latent factor that is ever present. It's present in the event window and the non-event window. If all I'm seeing is background level moving everything around all the time, this is going to absorb all of that effect, okay? So let's see what that looks like. And here I'm going to blow up these relative R-squared contributions. What we're going to see is with no factors, my R-squares are low. With one release-specific factor, it goes up a lot, okay? And this one this time is for the US yields. When I add in all factors here is, so I could do this for release-specific factors, I could do this one factor across releases, it's all the same. But all factors, what this adds is the ever-present factor in there. remember that these things are orthogonal to each other. So I can treat the changes here as marginal R squareds. Okay. What this says is, this is the blue. This is the 5-year maturity. Okay. At 5-year for the US, the R squared on the observables is 27%. R squared for observable and the latent news goes up to 85%, and it's only 10% marginal R squared from the ever-present factor. Okay, and that's the same for the 5-year here, the 10-year here. The action is in the news. Okay, observable or unobservable. How about the euro area? Do the same thing for the euro area. On the short end, you get the same thing. Okay, right? It's 20% goes to 70, goes a bit more up when you add the ever-present noise. Okay, but on the longer end, this is the 10-year now. The observable surprises move the yield a little. The unobservable surprises, the latent surprises, also move the yield curve yield a little. Most of the action comes from the noise. Okay, so that's the paper we're working on now. And the question is, why is that the case? Why is Europe so weird? Okay, and the answer kind of seems to be, it is the US that is weird. But first, I have to tell you what is stopping us from getting this out as a working paper. What Mark noted, to his great credit, is we called this thing the ever-present factor. This is the noise that's moving the yields the same way in the non-event window and the event window. He had the presence of mind to check its behavior separately in the event window and the non-event window, and found that this thing has a larger variance in the event window. That should not be the case. If it's ever-present noise, it should behave the same way in the event and the non-event windows. So we understand that it's not just the ever-present noise. It must be proxying for something else in the windows where the releases are taking place. Our thinking is this is probably mostly due to time variance in the parameters, because we are enforcing a time invariant reaction of the yield to the same types of releases, which is most likely incorrect. Okay, so that's what we're trying to understand. Are we to go for a time varying estimate, or should we think about this as a second latent factor that soaks up that variance? We're working on that. Okay, and if any of you are interested, this really is a Wild West type of, nobody began to look at these things yet. So a lot to be done. Okay, now, having said that, it is the case that the long end of the euro area yield curve behaves differently from, this is the long end. The long end of the euro area yield curve behaves differently from the long end of the US yield curve. Okay, and somebody is very unhappy about this. It's not because of noise behaving differently at different maturities. These two things show you the noise variances at different maturities for the US and the euro area. Okay, and what you see is it's the same. It's not that the euro area long end has more noise in it. It actually has exactly the same noise as the US. Now, what is different? It has less news contribution. One way of seeing this is to look at the variances, the histogram of the yield changes in the event and non-event windows. Okay, so the dark shaded area is the histogram on the left for the US, on the right for the euro area for the event windows, and the light shaded area is for the non-event windows. So what you see is that the event window variance, okay, it's the other way around, I apologize. The event window variance obviously is larger because there's more news happening there. The light shaded, I'm terrible. Okay, the light shaded, the bluish one, this is the event window, and the brownish one, this is the non-event window. Okay, the heteroscedasticity is the variance between these two things. And these histograms in the US and the euro area for the 3-month look quite similar, right? Because what happens is there is a lot more event contribution to the total variance in the US And there's a lot more event contribution to the total variance in the euro area for the 3-month yield. Now look at this for the 30-year yield, for example. You see the same thing, right? A lot more variance in the event window in the US compared to the non-event window in the US. Look in the euro area. The event window variance and the non-event window variance are about the same. Apparently, news aren't really moving the long end of the euro area yield curve, and that's why relative R-squares are so different. Why would that be the case? Okay, and there the answer, still working on this, seems to be, but don't take my word for it yet. Okay, I'll skip this one and that one. But the answer seems to be inflation. Okay, it seems that inflation compensation moves a lot more in the US in the long end and a lot less in the euro area in the long end. That's your anchoring story. Okay, so now I have news, noise, and anchoring. And once you get those 3 things right, it seems that you understand all of the international yield curve in the US, in the euro area, how they affect each other. And notice that the title of this paper is a declarative sentence. News, noise, and anchoring shape international yield curves. That's what it is. Once you understand the effects of news, noise, and anchoring, you understand the entirety of the yield curves. This is a bit stronger than I'm ready to push, because now I learned that, that noise is behaving in ways that I didn't expect, okay? But that still seems to be the case. Thus, just as I'm hitting the hour mark, I am done here. The following is absolutely correct. News are multidimensional. Whenever you're working with data releases, high-frequency news, event studies, you have to remember that what you measure as news is a subset of what the public perceives as news. Because think of yourself, right? When last Friday the non-farm payrolls number came out, you first looked at this and said, holy cow, I was thinking 200,000, it came in at 500,000. And then, 10 minutes later, you were talking about, is it the seasonal factors behaving differently this time? That's a separate kind of news. And you have no way of including that news into your regression because you haven't asked anyone, what did you think the seasonal factors would be like? What have you learned the seasonal factors are? But people actually did perceive this. They reacted to this, okay? We can actually think noise as a well-measured object. We don't have to treat it as a residual, okay? It is the anchoring properties of inflation expectations that lead to a differentiation in the long end yield curve movement, and in particular, conditional long end yield curve movement in the event windows, conditional on the data releases, that lead to a differentiation between the euro area and the US, okay? And with that, I can tell you that we, it turns out, understand a lot more about what moves yield curves. It was always news. It's just that our understanding only extended to the news that we could see. And we didn't consider the possibility that the public saw a broader set of news than we as the econometrician did. The moment we said this may be the case, we were able to combine OLS and heteroscalar space identification, come up with an efficient estimator of observed and latent news, and relate yield curve movements to those, where those news actually did a great job of explaining the yield curve movements in the event windows. Hence, news, noise, and anchoring shape international yield curves. So with that, I stop, and thank you for your patience.
Thank you very much, Refet, for this incredible presentation, and I'm quite surprised by the results. They are excellent. So please raise your hand if you have any question. I will ask one, but it's so if I understood well, the differentiation between OLS and the heteroscedasticity is that the heteroscedasticity takes into account the variance of the window and OLS not. And then one question popped up is that okay, so looks, I want to analyze two different kind of news. You took the relevant example of the unemployment report, and let's take inflation announcement, whatever. My question is that when you do that, you fix the window of analyze, so the same windows. And in my opinion, it should not be, because as you said, you maybe take more time to understand and collect the information of a 40-page report compared to maybe 2-page report for inflation or another news. And then my question is that maybe there is a way, I don't know, maybe there is a way to customize the window with respect to the amount of information, the organization of the information. How do you take this into account?
We don't, and that's a great question. And this is something that I throw out about the good research idea all the time. But the point is, one cheap way of doing this, which we have done, is to say, maybe 20 minutes is too narrow. So let's look at an hour, or let's look at the full day. Okay, market close to market close. Okay, you find the same things. All right. So functionally, you find the same things, which makes you say, okay, it isn't that people couldn't grasp the intricacies of this. There is an interesting question here as to the optimal window width. Okay, this is very fast, especially now, because a lot of this is AI trading, right? It's not like you and me have to go through, flip through 40 pages of stuff. It really is your what's called robot, right? Downloads the entire report, looks at the numbers, and trades based on it, because you have already conditioned it to think of the surprises in all kinds of subcomponents of this. Okay, that's really what is moving the reaction now. Having said that, let me recommend you to watch Bloomberg News at the time of an employment report release. Okay, at the time of a CPI release. These are the big ones these days. Okay, what's going to happen is you're going to get a banner, CPI to be released in 2 minutes time, and then there's going to be a countdown. And then you're going to hear these guys talk about this for 10, 15 minutes, longer than that, okay? And it's going to be, holy cow, right? We thought inflation was going to be this, it came in at that, okay? This is minute 1. And then within minute 1, they will be talking about core inflation too. By minute 4, they are talking about the core inflation excluding housing, blah, blah, blah. By minute 8, they're talking about the sub-index that the Fed is caring about these days. Okay, that is services. Okay, do the same thing for example, the employment report. By minute 10, they are talking about this actually happened. I remember this. Okay, they're talking about the contribution of government employment that is non-federal employment only at the state level, which excludes teachers' employment because they are so seasonal around the times of the summer holidays. Okay, meaning people actually process these things very fast. The 5 minutes before to 15 minutes after window, that's actually very wide. Okay, everything gets done in there. You're absolutely right that for some releases, clearly you need less. In things like retail sales or durable goods orders, right? It's only 1 or 2 things that really matter. The employment report, they really work through it. Okay, you could actually ask a good statistical question about what is the optimal window width for different data releases. Essentially ask, when does let me begin with a very narrow window and then begin to extend it. When does the transmission parameter seem to stabilize so that all of the data is incorporated? Okay, and at which point I'm just increasing the noise. That's a very well-defined question, which is easy to answer. Nobody has done this. Okay, so I'm agreeing with your question. I'm sure the answer is not going to be longer than 15 minutes, right? But I haven't done it myself either, so somebody should. And then you can actually do this for different optimal window widths for different data releases, and that's going to be a cool thing to do.
Thank you very much for this very interesting reply. So I'm asking again for the audience, if they want to ask a question, please raise your hand and I will enjoy that. So I will let talk Gökhan, and after I will come back with another question. So Gökhan.
Hello, thank you. Fascinating work. I just have a question on the difference between the, for example, Euro area 10 yield response to the US 10 yield response. Is it possible that also in the Euro area, because, and I am not saying this, but maybe some market participants, when the QE policies of the ECB started, also maybe it could have been to support the periphery yields. Could it be possible that the market is not reacting as strongly simply because they cannot be sure, okay, this is an inflationary news, but ECB cannot react and they don't know what ECB would do due to such bond market fragmentation story?
That's not impossible. We do this for different time periods precisely for this. You get similar things before the zero lower bound was binding. In fact, it's even more important for the lower bound because then the short end really cannot move. And so we do this for different windows and find kind of similar-ish things. But the question is really there. It's also the case that if anything, this is going to affect the US more because the US QE was more focused on 10-year and the Euro area was had more weight on shorter yields. So the average yield was 7-ish in the Euro area actually. But good question, and hopefully somebody is going to pick up where we left off and think about these things. I nominate you, Gökhan Bey. But you have the right toolkit, right interests. So I think you really should be thinking about these things.
Thank you very much, Gökhan, for the question, and Refet for your reply. So we have a question from Akiva, Eduard Offenbacher.
Okay, thanks a lot. I have actually two quick questions. One is whether you can say something about the anchoring of inflation expectations using tips and using the break-even inflation. You might be able to say something directly using the same general ideas, but using different, data and inflation expectations. The second question has to do with your discussion of the markets, the size of the window and what the market reacting. I think there's also beauty contest issues here. In other words, the traders have to take into account not only how fast they're processing the data, but how much they think is already priced in at each instant. So that and then it gets very tough, I think. So I'm not sure. I was also wondering about the question of the window. I think it's a big issue.
Okay.
A big issue.
Two excellent points. Let me begin the first one. I actually very briefly showed this to you, but since I flew through it so fast that it wasn't clear, we actually do this. Okay, we look at the forward inflation compensation in the US and in the Euro area, and we show that it actually is the tips-based inflation compensation measure, break-even measure, that's moving around in the US and not moving around in the Euro area. So you're absolutely right, and we do that. Okay. The second thing is you're also absolutely right in that. In fact, if you look at the market reaction to any data release, okay, what you see is on impact, the yield, equity price, exchange rate, whatever it is that you're looking at, it jumps first, okay? And most of the action is immediate. And then it begins to move around a lot, okay? Indeed, in the rare cases, when we have volume data, what we see is that initial jump is with almost no volume. That's your beauty contest. Everybody agrees that more or less it's going to jump somewhere here, okay? So you don't trade on that. And then, I think that it should have jumped up 2.2 basis points. You think that it should have jumped up 2.3 basis points. We begin to trade on that. So there's huge volume and small movements in the asset prices. So it's very clear that you have done this, so you know this, and you are right on a systematic basis. This is something that always happens. Yeah. Again, this is lightly documented, but it's mostly anecdotal evidence for nerds like us that we actually look at the data release and the market reaction with an eye towards these things. Right. So we know, but this is one of those things that somebody is going to show this better. There is a very nice paper by Jonathan Wright and his co-authors that actually documents this for 1 day for one non-farm payrolls release on the, I think, dollar-euro exchange rate, and shows that it first jumps up and then trades in this small band as people are trying to figure out what exactly is the right price. Yeah.
Okay. Thank you very much,
Thank you.
Akiva, for
Thank
your
you.
question.
Okay.
Yes, you have. If there are additional questions from the audience, please feel free to raise your hand. So I have a last one because I want to continue my issue of the window and the type of announcements, because this is very close to my research area on analyzing text and stuff like that. And then I'm just asking to myself, and then I would like to ask to you, is there a way to control for the complexity of the text or for the quantity of the text? Because Bloomberg, your example of Bloomberg is very nice, but it's not automatized. And then I'm thinking more on a more automatized way to analyze this. So do you think there is a way that if we have the number of words and the complexity of the text and the readability of this text, and then we control on your work, is it doable?
Wonderful idea, very difficult. There is one particular data release where you can do this, and that's the monetary policy statement. Since it's not just numbers, but text, actually you can take text and you can turn it into a quantitative measure of complexity. And such things exist, okay? So how long it is, how large words are being used, how long the sentences are.
So this I have done already, but not related to the window. And then maybe
Right.
it's a very interesting idea. But
this
my idea was related to the reports of unemployment of 40 pages.
So I don't know how you would do it, right? That seems, I don't know an independent way of just looking at a data release report and ask, how complicated is this? You can look at the number of releases in it. You can look at the length of the report. Maybe they are indicative, but I have to admit, I actually don't know how long the durable goods report is. Maybe it's very long, but nobody cares, right? Because it's a combination of length, complexity, but also whether I care about the tiny details in there, right? So you're asking for something difficult, and I don't have a ready framework to answer that question, other than saying it's a great, great question.
Thank you very much. Any additional questions on the paper from the audience? Okay, thank you very much. So we will, and thank you very much again for this fantastic paper and the results. I was very surprised for these very excellent results.